Electric vehicle maker NIO has a market cap of $14.7 billion. With $4.8 billion of cash and $3.7 billion of debt, the enterprise value is $13.6 billion. The company has delivered 127,000 vehicles over the last 12 months and generated $7.3 billion of revenue. However, NIO is not profitable. The company lost $2.5 billion over the past 12 months, with an average gross margin of 7.8%. NIO makes good cars, but before we go any further, we have to discuss NIO's first quarter earnings. As you can see, first quarter revenue at NIO was up 7.7% to $1.6 billion, and the company delivered just over 31,000 vehicles. But this number was below target, and revenue was in fact down a third from the previous quarter. More importantly, NIO barely made any profit in the first quarter. Gross profit in Q1 collapsed 89%, and the company lost $744 million. That's 133% up year over year. The gross margin was only 1.5% versus almost 15% a year ago. So what's going on? Well, NIO's production costs have increased, but the company isn't selling enough cars, and the company can no longer rely on government subsidies. The ET5 is arguably NIO's most important car, but according to the Electric Viking, pre-order times for the ET5 have gone from 3 months to just 2 weeks. That suggests decreasing demand. Meanwhile, the company has been burning cash on battery swapping stations and implementing its auto-driving stack. Despite this bad news, NIO's stock is actually up 18% since it reported earnings. And that's because NIO has finally recognized the trouble that it's in. Management is now cutting back on R&D, and it's cutting prices on its cars. It's ending its free battery swapping service, and it will soon be selling its cars across Europe and later the US. And NIO really needs to do this because at the current burn rate, the company could run out of cash within the next 2 years. The problem is that none of these solutions, except for geographic expansion, are going to be good for NIO long term. The fact is that the company is now engaged in a price war with other EV makers, a list which is currently dominated by BYD and Tesla. Both of those companies are profitable and have significantly more scale. Overall, the EV market is heating up, and it's hard to see how NIO is going to compete unless consumers start to fall in love with NIO's cars. Right now, that doesn't look likely, and this company doesn't look like a good investment. That's why I give the stock a negative rating, but these are my personal opinions, not financial advice, and I've got no position in NIO stock. For more detailed investing ideas, visit our website overlookedalpha.com.